Gold is up nearly 35% over the past year, but it's been a wild ride. At one point, it fell nearly 29% from its earlier peak. Now it has rebounded almost 13% this month. So where does gold go from here? Even analysts at Goldman Sachs and JP Morgan cannot agree. I'm advisor Andy, host of Inspired Money. Today, we're talking about investing in gold, one of the world's oldest stores of value, prized by cultures across centuries. Economic uncertainty and geopolitical tensions today have strengthened gold's appeal as a perceived safe haven asset. But gold doesn't generate income, its price can be volatile, and its role in a portfolio is frequently misunderstood. Today, we're going to separate the enduring case for gold from the market noise and help you understand what could drive its next move. But first, a quick word from our sponsor, my financial advisory firm, Runnymede Capital Management. Markets do not come with roadmaps, but your financial future should have a plan. Whether you're preparing for retirement, reviewing your investments, or simply wondering if you're on track, you can create a complimentary financial plan in about 3 minutes. Visit inspiredmoney.fm/getplan, answer a few simple questions, and receive a personalized snapshot of where you stand and the next steps you may want to consider. Again, that's inspiredmoney.fm/getplan. One quick disclosure, some of today's pre-recorded segments use an AI-generated version of my voice. The words and analysis are mine, and I write and approve every script. As always, this program is for informational and educational purposes and is not individualized investment, tax, or legal advice. Now let's bring in our guest. Joining me are three outstanding individuals. Juan Carlos Artigas is Global Head of Research and Regional CEO for the Americas at the World Gold Council, where he oversees research into gold market dynamics and its role in portfolios. Previously, he was a fixed income strategist at JP Morgan Securities. Cam Harvey is a Duke Finance professor, National Bureau of Economic Research associate, and former president of the American Finance Association. He has published extensive research on gold and global asset allocation and is also a partner at Research Affiliates. Paul Mladjenovic is an investment educator and CFP board emeritus professional with more than 4 decades of experience. He's written many books in the For Dummies series, including Investing for Dummies, Investing in Gold and Silver for Dummies, and Precious Metal Investing for Dummies. Gentlemen, thank you for joining me.
Thank you.
Thank you for having us.
Thank you for having us.
We're going to jump right in and start with segment 1.
A shift in Federal Reserve policy can rapidly alter institutional market forecasts. When the expected path of monetary policy changes, major institutions recalibrate their economic and market models. Following recent revisions to interest rate expectations, some Wall Street research teams lowered their gold targets, arguing that delayed rate cuts increase the opportunity cost of holding a non-yielding asset. This raises an important question. Have higher real yields restored their traditional influence over gold prices, or are broader economic forces changing that historical relationship?
Cam, your research challenges the idea that gold is a reliable short-term inflation hedge. When rates remain high, what has to be true for gold to keep rising anyway?
So the first thing is that gold is a volatile asset. Think of gold as being as volatile as the S&P 500. So that means that there will be a lot of dispersion. It means that gold could be a very effective short-term inflation hedge in one particular period and completely ineffective in another period. So given that volatility, it works sometimes it doesn't work. The one thing we do know is over the extreme long term, over millennia, gold has held its real value.
Juan Carlos, when rate expectations change, what does a bond strategist see that a gold strategist might miss and vice versa?
Well, that's a very good question. The first thing that I would say is that we look at gold from the perspective of four key drivers. Okay, there's four drivers to the gold price. One of them is economic expansion. The second one is risk and uncertainty. In a broad sense, we can discuss later. Then we have opportunity cost, and then finally momentum. Within opportunity cost, there's going to be a natural negative correlation or relationship between interest rates and gold. So obviously, the higher nominal yields go, the higher the opportunity cost of gold, and therefore, they decrease. Now, what specifically to your question, I think that what is interesting here is that gold is a risk hedge, very generally. It may be really high inflation, deflation, but it's just more generally about high risk. And this is why the relationship is not linear. And I think that what gold is capturing, and especially capturing now, even as the long end of the interest rates curve is increasing, the reason why gold is increasing as well is because of this risk component, this risk premium that investors are using in many ways gold to hedge against.
Paul, savers are very happy that interest rates are no longer at zero. So if we're looking at a choice between an attractive treasury yield today and gold's potential protection tomorrow, how do you explain that?
Oh, first of all, you're talking to a gentleman who was a certified financial planner for 36 years. And, we say the word diversification in our sleep, over all that time frame. And for me, if people ask me, should I have gold or should I have some of these other paper assets that can provide an income? My answer is yes. Both have a place. I mean, in different degrees based on who the people are, et cetera, and so forth. But people have to remember that in times of uncertainty and in times of instability, whether it's currencies or political systems, et cetera, gold has the ability to retain its value in ways that have not been matched by any other traditional investment asset. So I believe that gold and silver both have a place. Again, not an overwhelming place because I think the world is generally stable right now. But when things do become unstable, people do rush towards gold and silver, and they will be glad that they have it on hand because that's what the world wants. Because gold and silver provide what generally currencies and political systems have not provided over the extended period of time when you have much instability and uncertainty, and people need that because when you're using a diversified approach, you need, of course, for things that grow, they give you income, etc., and cushion and emergency funds and everything else. But gold and silver have a place because gold and silver are the precious metals are a diversification against the risks of counterparty risk that many paper assets have. So definitely they should have it. And right now, I think it's as good time as any, so that you can have a broad approach and be diversified, so you can handle whatever the world throws at you.
Cam, any response to Juan Carlos's four drivers? What's most relevant today?
Yeah, so I generally agree that the gold price is driven by multiple factors. Whether it's four dominant factors, or more. It's also the case, and this makes it even more complicated. The importance of different factors varies through time. So even if you knew the driving forces, you don't know the different effect that each has and how it changes through time. So let me just briefly comment. I agree that gold has very interesting properties in terms of diversification. It's a rare asset that, at least since 1971, its correlation with the S&P 500 is on average zero. And that means that it's got a hedging property that's expected. However, I do want to emphasize that given the volatility of gold, that sometimes it doesn't work as the safe haven in economic stress. So in terms of the four driving factors, I would add one additional factor, and maybe it's under the economics part, and that is the consistent interest of China in accumulating gold. From official holdings, we've got some idea, but there's also the unofficial buying. As most people know, China has a relatively small amount of gold compared to the US.
Let's move on to the next segment.
While Western investment flows often respond to short-term interest rates, global central banks have maintained significant demand for gold. Sovereign institutions continue to diversify their foreign exchange reserves, seeking to reduce currency concentration and manage geopolitical risk. Measuring this demand requires care, however, because official disclosures and over-the-counter estimates can vary considerably. Central banks also operate under mandates, liabilities, and time horizons that differ fundamentally from those of individual investors. Does sustained official sector buying change gold's long-term market dynamics? And what, if anything, should private investors take from it?
Juan Carlos, the World Gold Council tracks purchases that are not always immediately visible in official reports. Since Cam was talking about China's demand for gold, can you give us some insights? And what does the public misunderstand about most central bank gold demand?
Yeah, that's a very important point. And look, I think that I understand that to most people, again, to most investors and experts on financial markets, when you look at gold at first hand, it looks, very messy and complex, and you don't necessarily know which is going to be the most important factor. And I 100% agree that naturally, as with any other financial asset, elasticities and sensitivities will change. But one of the things that actually became quite interesting to me when I started to look and work on the gold market is that in the end, gold is intuitive. Yes, there's moving parts and so on and so forth, but it's intuitive from the perspective that in the end, it's a market that is reflecting market balance. So you have, but you need to take into consideration that gold demand is not just investment. It's a combination of consumers that are economic rational actors, responding to certain stimuli and to certain factors. Then you have investors that also are responding to these factors. And then finally, central banks. Central banks are by now about 20% of annual demand on average, right? And many of them are making policy decisions, and their policy decisions maybe are not as easily modeled as what you would expect with a combination of, consumers, millions of consumers, or millions or billions of investors, right? So central banks are, have become quite important. Central banks became net buyers as a whole in late 2009. And since 2022, they have accelerated those purchases. And again, it's a combination of central banks. It's not just one. So it's emerging market central banks as a whole have become, quite important in this arena. And we conduct a survey actually once a year. It's been 9 years since we conduct these surveys. The last one this year, we had 75 central banks participate. That's more than 50% of kind of like the most important, institutions, central bank institutions around the world. So it's very representative, right? And when we ask, why are you buying gold and what are your expectations? The first point is diversification. So diversification is a really important part of the reserves. And yes, while gold is more volatile than a bond, actually is less volatile than many other assets, certainly commodities and so on and so forth. And it also depends on what your numeraire is, like what other currency you're using to measure against. And as Paul mentioned, it doesn't have credit risk, right? So it helps balance the market. So it brings more price volatility, but it helps manage risk in other ways. Either way, so the main point here is diversification is a key point. The way that gold performs during types of crisis is another point. And for emerging markets in particular, and the gold has become an important way to hedge geoeconomic risk. So all in all, our models actually suggest that excess demand, about like 20 to 30 tons of excess demand from central banks, contributes to about 1 percentage point increase in the gold price. I mean, ceteris paribus, we're simplifying, but that's also the reason why the gold price has been increasing for the past several years as one of the contributing factors.
Cam, if you were advising a central bank rather than a household, how would sanctions and counterparty risk change the case for owning gold?
So again, gold is perceived as a safe haven asset. And given the sort of economic stress that we're under today, I think that a number of investors are thinking of further diversifying their downside protection. And this is also true with central banks. So this is not just the average investor, whether retail or institutional. Central banks looking around, looking at the $39.9 trillion US debt, and the fact that 20% of our tax revenue goes to just pay the interest on our debt. So central banks looking around, and it's kind of the same issue that they need to diversify, which means to attempt to reduce their reliance on US dollar and or at least not increase it. And if you go for an alternative asset, the first stop is gold.
That $39.9 trillion of US debt is a thesis that I think is driving a lot of individual investors. Some that I'm hearing never considered owning gold before, but then they look at the balance sheet, the debt of the US, and say, I think I may want to own some gold in my portfolio just in case. Paul, central banks can hold gold indefinitely while families need liquidity and income. What's the danger in trying to copy what the central banks are doing?
Well, when we're talking about danger, obviously every individual family out there has their own situation. They should always be having their own emergency reserve of their currency, so to speak, for when problems occur. But they should have, at least to some small extent, gold and silver as part of the picture. Because understand why central banks across the globe have gold. They understand, if they understand the lesson of history, over the last 2,000 years, the most common collapse in the last 2,000 years has been a currency collapse. There's literally hundreds and hundreds of currencies that have collapsed into oblivion because they are subject to potentially overproduction. Gold has a finite supply. When we talk about how much we are able to add to it over that time frame on a given year, it's roughly like 2% we add. So it's very finite. So sovereign banks and individuals should understand that reality, because when currencies are overproduced, that lends itself to inflation. And the thing is, assets that are of limited quantity tend to hold their value and even, in some cases, prosper during times of inflation. It's happened many times with gold. And I think individuals have to do the same thing as what sovereign banks do, to add a little bit to it, because you need diversification against the overproduction of currencies, which themselves cause many problems from government budgets down to family budgets.
Let's move on to segment 3.
Following gold's retreat from recent highs, Western exchange-traded fund outflows have highlighted a divergence between private investment flows and sovereign demand. Rising treasury yields and the income available from cash and bonds can make a non-yielding asset less attractive, leading some institutional and retail investors to reduce their exposure. As gold consolidates following an extended rally, market participants are assessing whether this represents normal rebalancing or a more significant challenge to the investment thesis. What evidence would indicate that gold is stabilizing, and what would point to further weakness?
Paul, when gold falls sharply after a major rally, how can you tell whether the thesis has changed or whether emotion is taking over?
Well, the first thing I look at really is, and I'm glad you have the gentleman from the World Gold Council, because you want to see about the aggregates going on. Gold is still limited, and the problem in the last few decades, whatever, that sometimes you have market impetus where there's many people flowing in and flowing out of these things. So you're going to have corrections, crashes, booms, etc. So for me, I take a look at it from I have positions for myself where it's both long term and short term, and in what I do, because I'm a speculator in one part and I'm an investor on the other part. For the investors out there, they need to understand that right now, when you take a look at the aggregate worldwide supply and demand, and you see the juxtaposition of the rest of the world out there, where there is massive debt out there. I think a lot of gold a lot of central banks out there are seeing that the primary bank in the and the primary economy on the globe is overextended to the point of nearly 40 trillion in debt. That does not bode well for stability. It does not bode well for valuations, and for inflation, et cetera, and so forth. So yes, as far as I'm concerned, gold has a place now. And in terms of the current situation, what I see in the current situation is that, yes, it's been a sharp pullback. Doesn't bother me at all, because as far as as I can tell from my research, the long-term fundamentals are still strong. So higher prices in gold and silver do appear in my expectations in the near future.
Juan Carlos, beyond price, what indicators do you watch to determine whether gold is stabilizing? ETF holdings, physical premiums, trading volume, or something else?
Yeah, well, a combination of things, and this is really interesting. So let's talk about a couple of things. First, gold-backed ETFs. Gold-backed ETFs obviously have become an important component of the gold market ecosystem. They came about, kind of like mid 2000s, like the first ones around 2003, 2004, especially in the US. But by now, collectively, there are about 140 or so gold-backed ETFs around the world. Mostly, or the bulk, are still in the US and the European markets, and therefore they overrepresent maybe some of the sentiments that you mentioned. So, but the Asian market is also increasing on that front. So, collectively they hold about 4,000 tons. That's about kind of like 2% of the overall, outstanding gold above ground stocks, right? So it is an important but still small percentage of the market. But what do we see to answer your question specifically? One of the things that we have been looking at is intraday gold price performance. And if you divvy up the performance of the gold price in the Asian session, European session, and US session, of course, we're simplifying these overlap, but just to try to understand. And you actually look at gold's performance during Asian trading sessions overall this year, the gold price would be about 15% higher, right? So the point is that there's actual demand happening in Asia through various forms, not only gold-backed ETFs. There's also bars and coins, there's derivatives and so on and so forth that are helping price discovery. So price discovery is no longer just Western markets, whether it is the US or London as traditional gold hubs, but also the participation of Asian markets. And the fact that we have seen strong demand is telling you that stabilization. The second point is you talked about gold ETFs specifically and the outflows we saw in Q2. However, by now, both in July and August, we have seen again a rebound in inflows. And in August alone, month to date, we've seen about $7 billion come in across the board, so across all regions, right? So this is telling you that following that really increase in high volatility, and Professor Harvey mentioned this, the volatility of gold, which actually increased at the beginning of the year. Once that is stabilized and came down, some of the derivative positioning started to cool down as well, the more speculative one. The price is stabilized. We started to see again, more steady flows come in little by little, coming at the beginning of July and now in August.
Cam, you mentioned China earlier. You also mentioned volatility of price of gold. Can you elaborate on your thoughts on China? And does adding China as a factor, does that present a case for a long-term buying of gold for investors?
So obviously gold is determined by supply and demand. And as was pointed out, the new supply of gold is very limited. It runs at less than 2% a year over the last 10 years. But given that the supply is so sticky, so you can see the price of gold double, yet the new supply coming online doesn't respond. So given that the supply is so fixed, any small change in demand can have a dramatic effect. And again, there are many different sources for this demand. We've talked about central banks, and Bank of China is a bank that has been consistently buying. But you also need to look at the gap between China's holding of gold and the US holding of gold. The US is the reserve currency in the world. And people are thinking, again, with that $39.9 trillion debt, that we need to look around. And China's been extremely active here in establishing bilateral swap agreements with, I think, over 30 countries now that allows them to trade without US dollars. So that's very important. And I do think that it is a factor, one of many factors that has positively influenced the price of gold.
Cam, what evidence would persuade you that this correction that we've seen since the second quarter is normal consolidation rather than the unwinding of an expensive asset?
Yeah, so you could have many people on the show that would give you, some story. And it's not just about gold, it's about why whatever stock went up or down. These are extremely volatile assets. So it is expected that there will be, just by chance, movements, but people will tell a story about the movement. So I just think that we need to be careful here. There are some obvious forces. And look, the price of gold over the last couple of years has gone up dramatically. The real price, so if you take inflation into account, the real price is very high. And we know from my research that when the inflation-adjusted price of gold is high, what happens over the next 10 years is not great. That needs to be balanced with the fact that a hedging asset, so an asset that has no correlation with the stock market, you don't expect to have a very high expected return. So that is the price of the insurance.
Excellent point, and thank you for the objective and balanced thoughts. We've examined what is moving gold, but a rising price doesn't tell you whether gold belongs in your portfolio. If you're just joining us, welcome to Inspired Money. I'm your host, advisor Andy. In this Act 2, we're asking the question that matters most for investors. What job should gold actually perform? Let's examine when gold has protected portfolios, when it has failed, how geopolitical risk changes the case, and the trade-off among physical bullion, ETFs, and mining stocks. Later, UC Berkeley economist Barry Eichengreen joins us to explore gold's role in the changing global monetary system. But first, let's continue with Act 2 and jump into the discussion with Segment 1.
Evaluating gold within a diversified portfolio requires an objective look at how it has historically behaved relative to stocks, bonds, inflation, and interest rates. Foregone yield represents a genuine economic trade-off when cash and fixed income offer attractive returns. Although gold is often described as a portfolio hedge, its performance varies across different market regimes. It may behave differently during a liquidity crisis than during an inflation shock, currency devaluation, or geopolitical event. Under what economic conditions has gold successfully diversified a portfolio? And when has it failed to provide the protection investors expected?
Cam, centuries of data led you to call gold an unreliable short-term inflation hedge. If that's true, what portfolio job can gold perform well?
So again, most investors are not trading with a horizon of 1 day or 1 week or even 1 year. So most investors have longer term horizons. And when you've got a longer term horizon, it gives you a chance for some of that noise in the price of gold to cancel out. So historically, and that's an important word because we don't know for sure what's going to happen in the future, historically, gold has played a very positive role as a diversifier in a portfolio. So that zero correlation means the market could crash, but the stock market could crash. But on average, you would expect gold to hold its value. Okay, so that something holding their value in a crash-like situation is very valuable. So I would, at some point, like to change the discussion a little bit because we're talking about gold's role as a store of value, as something that's helpful for your portfolio. I would like to pivot at some point to talk about gold as a medium of exchange in the future and the implications of that.
We will definitely have to return to that. Juan Carlos, can you share some of the research that you do at World Gold Council as far as adding gold, and does it improve hypothetical portfolio outcomes?
Yeah, absolutely. And look, I think that it is very important to note a couple of things that Professor Harvey has mentioned. So number one is gold's volatility. And yes, of course, as he mentioned, gold is more or less has an average volatility equivalent to the S&P 500. Now, in fairness, the S&P 500 is a diversified index. So when you measure it against individual stocks, gold actually ranks fairly low, and it's also the lowest, it has the lowest volatility amongst commodities in general. So of course, you do need to take into consideration the volatility that naturally the gold price exhibits. But in the context of broader financial assets, I would say that it's not, a super volatile asset. It's actually maybe kind of like on the potentially lower quartile. But the most important thing is that from a portfolio construction perspective, you need to think about not only volatility of the individual asset, but the correlation. So it's like in the covariance matrix, in the composition of the portfolio, it is the combination of volatility plus correlation that allows you to form these more robust strategies. And look, obviously portfolios, what people are looking to do is to increase returns as much as possible. Our inability to forecast the future, which of course, Professor Harvey mentioned as well, you can only rely on history, but you cannot necessarily know exactly what will happen. Those force you to, or pushes you to look at diversification. One of the things that we have noticed in our research is not only gold's conditional correlation is really low, which is useful, but the unconditional correlation is really low, but the conditional correlation, right, especially when the stock market pulls down, tends to be negative, and that's what you're looking for in a diversifier. Interestingly enough, when the stock price increases, the correlation turns slightly positive. These are, of course, on average, right? So it's not going to be every single day, and so on and so forth. But it does allow you to be to add an asset that can be a very useful diversifier across different macroeconomic environments, and especially one that can help you when there is a significant pullback in the stock market, and that has been fairly consistent through time. So the research that we've done summarizes gold's role in 3 points. The first one is long-term returns, which is what Professor Harvey was alluding to in terms of the long-term capital appreciation of gold for various reasons, including not only the scarcity, but the use it has as a store of value. The second one is the diversification and kind of like quite effective, contribution to other assets and how they interact. And then finally, liquidity. Gold is an extremely liquid asset. In the OTC market, in the spot OTC market alone, we're talking about more than $120 billion a day traded, right? So it's an asset that you can get in and out fairly easily, especially in financial markets, in the financial market context, which again allows you to use it in periods of risk. So in that context, those are the 4 tenets of the reason why our analysis shows that gold can help create more robust long-term investment strategies.
Paul, with your CFP hat on, how do you prepare investors for the fact that an asset bought as protection can still fall sharply when protection seems the most necessary?
Well, first of all, in all environments, I'm not always bullish on gold. I mean, when I first started teaching investing in 1983, I was actually very bearish for a number of years during the 1980s. Why? Because gold does not excel in times of stability, in times of low inflation, in times of currency properly managed. In those stable and peaceful times, gold is not a great component of it. So I tell people, but then what happens when that changes? Everything is fine until things change. Right now, it's sunny outside, looks beautiful, the economy looks great, but next week, next month, or next year, all of a sudden there's chaos. So what people have to understand is, again, gold doesn't have to be a major part of your diversified portfolio, but it does occupy, I think, a small segment. For many people, it may be 5%, whatever, more or less. Again, everybody's different, so I'm just giving you a template. But keep in mind that gold is beyond just an investment and an asset. It is a form of insurance, because when those times do emerge, when there's high inflation, high instability, geopolitical crises, then all of a sudden, people say, I'm worried about my finances. I'm worried about what inflation will do with my savings, et cetera, and so forth. And you end up finding out that gold, again, has the role. Again, it's been having a role in people's finances to both minor or major lengths for over 2,000 years. And it survived every currency crisis, every political instability that's out there. So yes, people can tweak how much they hold, but I think having a small amount, and then what ends up happening is that when all of a sudden gold goes through the roof, then all of a sudden people can be able to do something like, well, let me cash out a small portion of it, and I can put those funds over here so I can pay for healthcare and everything else. So as long as you have a long-term perspective and understand the proper role of it, and don't go crazy with it, I think gold does have a part, no matter how minor, in everybody's portfolio. Again, because the world is always uncertain. There's always instability. There's always a risk around the corner. So you want to be prepared, because a lot of other people are not.
Cam, let's come back to your gold's exchange of value and why that's important in the portfolio.
Yeah, so it's really just another way to make the case in the future. So what we're really trying to explain is what to expect. So one thing that we would expect over the very long term is that the gold price should move with inflation over the long term. So this is something that we expect. So again, I said that most of our discussion has been around the hedging properties. And this is not a small asset. So this is a $30 trillion asset. So of course it should be in your portfolio as part of a diversified portfolio. This is really important. Again, I think we should also look at not just the store value and the insurance aspect to it, but the possibility that gold could be used as a medium of exchange in the future. And this has occurred in a small way in this area of tokenized gold. So we know about tokenized dollars, so-called stablecoins. Well, now we've got tokenized gold. So this gives you, think of it as a coin that represents a very small amount of gold. So what this does is open the possibility that we could de facto return to an opt-in style of a gold standard. That if you want to deal, if you want to pay with stuff in gold, then you can do that. And this opens so many other possibilities. So the idea of the tokenized gold is that you pay some money and then a certain amount of gold is put into a vault. You've got a token associated with it. But that token is just like money. So you can put it to work. You can easily lend it out. You could put it into an account to earn interest. So we talk about gold as being this asset that doesn't pay a yield. Well, we've got something right now that's operational that is tokenized gold where you can get a yield. And of course, if you've got an ETF, you could lend it out and get something, but that lending out might generate like 20 basis points a year annualized. So I do think that we need to look forward to the future. And this is, even if there's a small probability of using gold as a medium of exchange, that would open a very large source of demand.
Pretty mind-blowing to think about the possible evolution of gold in gold investing. This is a good segue into segment 2.
Geopolitical fragmentation and the use of trade and financial networks as instruments of national power have led governments to assert greater control over strategic resources. Some allocators believe this trend strengthens the appeal of gold as a globally recognized reserve asset that can be held outside traditional banking liabilities. Physical gold, however, also presents storage, insurance, regulatory, liquidity, and price volatility considerations. As geopolitical fragmentation reshapes trade and reserve management, does physical gold gain structural value from its lack of direct counterparty exposure? Or do its costs and volatility limit that benefit?
Juan Carlos, the segment talked about how gold has no issuer and no direct counterparty liability. Why has that distinction become so important to reserve managers?
Yeah, that's a really good point. And in some sense, again, that's the reason why gold has no yield. I mean, yield comes from a credit exposure, credit risk that you're incurring, right? That doesn't mean that gold doesn't have risk in other contexts or the volatility that we mentioned, but in particular, there's no credit risk. And depending on how you're holding it, it doesn't have counterparty risk, for example, depending on the way that you're directly holding it. And that can be, quite useful. And as we were saying before, that's one of the reasons why reserve managers, like foreign reserve managers, central bankers, look at gold in the context of broader foreign reserves, even though the other assets they hold are, indeed, usually coupon-bearing sovereign bonds, right? And the reason why is, in the context of, fiat money that Professor Harvey was alluding to, right? We stopped to being in the gold standard in the 1970s and the Bretton Woods collapse. And since then, gold still plays an important role. But I think that it plays a role now in the context of strengthening foreign reserves. And maybe that's one of the reasons why, many central banks like gold as part of the reserves to strengthen their own currencies, right? And whether it is direct or not could be quite interesting. I also agree that blockchain in general, or the evolution of the market and the strengthening on the use of that technology to interconnect the gold market more seamlessly can make gold very useful in many ways.
Cam, I want to continue your discussion on tokenized gold. I know that you're doing current research there. What kind of things should we be looking for changes in adoption of using tokenization? And could technology preserve gold's ownership benefits without reproducing the weaknesses of paper claims?
Yeah. So one thing that's really important to realize that this isn't completely decentralized in terms of gold, because most people don't hold the gold themselves. They trust somebody to hold the gold. So there's counterparty risk in that respect. If you've got your gold at a bank and the bank fails, well, it's going to be hard to get that gold. So I do think that kind of understanding that there is someone in between creates some risk. But overall, what this does is it effectively digitizes gold. So it's not the only thing that's being digitized. So as I said, stablecoins, USDC, for example, allows you to send a transfer anywhere in the world for the time span of 1 second to 12 seconds, a very small amount. So we can do this today with the stablecoin US dollars, and we can do it with tokenized gold. It's that you're sending a certain amount of gold, whether it's by weight or by the equivalent dollar value. So we are moving into a type of economy where you will have a choice as to what to pay for goods with. And I believe that gold is very attractive for this, given the long history that we've got with gold, the relatively short time span since 1971, when the US went off the gold standard, and that it's this homogeneous asset. So we can tokenize other things like NVIDIA stock, but that also is even more volatile, and it's more difficult to think about buying stuff in stock. So I do think that gold has got a strong case to be at least part of this ecosystem of the future, where people can choose to pay for whatever in gold and do it quickly, easily, and securely.
Taking a step back, Paul, what is the most expensive or dangerous mistake first-time physical gold buyers make?
Well, first of all, they overinvest in some of these things. I like to see people go into it like on a little now, a few weeks from now, and so forth. But the one thing I would like to mention, if I may, forgive me for diverting from your wonderful question, and I want to build on Cam's point. Obviously gold and silver have been stores of value and mediums of exchange for 2,000 years. But in today's world, you can't bring a gold coin or a gold bar into someplace and buy some groceries. So for me, one of the great things about our current times is that between the world of cryptocurrencies and blockchain technology, you have that ability where it can become a means of exchange much more conveniently and efficiently than ever before in the history of gold and silver. The second thing is that the world of ETFs, and I love ETFs, and there's a lot of traditional gold ETFs, and now you're having more of the gold and silver ETFs where they do inside income techniques such as covered call writing, etc. So now you have the point where a gold relationship could have income capacities involved. But the bottom line, going back to your point, Mr. Wang, is that yes, people have too much commitment to a lot of these things. And like a lot of things, and when they buy too many shares of a stock and they don't understand what it's all about and how it works, etc., they need to do a lot more research in advance, and then step in a piecemeal strategy, put it little by little, so they can have the dollar cost averaging involved. Again, I don't want people going crazy, because you still need money, your assets in other ways: an emergency fund, paying down debt, stock investing, dividend plays, and so many more things. So I answered the question in that much of an answer. Thank you.
Yes, thank you. We're going to bring it home and go to the last segment.
Major financial institutions currently hold meaningfully different gold price targets, reflecting contrasting assumptions about real yields, the US dollar, central bank purchases, investor flows, and overall market equilibrium. Rather than treating these forecasts as a binary choice, investors and advisors must first determine what role, if any, gold is intended to serve within a portfolio. What specific risk would the allocation seek to address? What circumstances could justify holding no gold at all? And if exposure is appropriate, how should investors evaluate the differences among physical bullion, gold-backed ETFs, and mining equities?
Cam, what evidence would justify a 0% allocation to gold, and what evidence would justify including it?
So let me deal with the second part of the question. So the case for inclusion is a very strong case. This is a major asset worth $30 trillion worldwide. So it's hard to make the case that a $30 trillion asset shouldn't be in a diversified portfolio. We've already talked about the insurance property. On average, not every time, but on average, in major market drawdowns, gold at least holds its value. So all of these are kind of strong reasons to hold gold in a portfolio. So your question is, well, could it actually be reduced to zero? And the answer is yes, if you manage your portfolio actively. What matters is a correlation, a volatility, a return that is forward-looking, not backward-looking. And it is possible, at least according to my research, that to see a relation between the inflation-adjusted price of gold and the returns over the next 10 years. So this is a forecast. And my research shows that when the price of gold adjusted for inflation is very high, the expected returns are low. Could they be so low that the expected return would be negative? That is positive. That is positive. So for a period of time, it might be that you liquidate your gold. Think of it another way. If gold jumped to $10,000 today, people would think, oh, well, that's very unusual. And we think maybe it's worth 5,000 and there'd be some reversion. Okay, so that's important to take into account in dynamically managing a portfolio. The volatility, the expected returns, the correlations, the downside risk, all evolves through time. And that could result in taking the allocation to zero, but that would be temporary.
Thank you, Cam. Thanks for spending the time with us. I know that you have to hop at the top of the hour. Paul, when investors compare owning physical gold, ETFs, or gold miners, how should they think about that in having exposure to gold?
Well, first of all, when I rank all these different types of gold-related investments, the safest one to have is bullion, in your hand. Okay, that's as safe as you can get, because the other gold-related vehicles do have some counterparty risk. You could put your money, you can buy a gold mining stock, and a gold mining stock, again, if gold is skyrocketing, great. What if that company is mismanaged, or maybe they are in an international jurisdiction where the government decides to interfere with the company, etc., in their operations and take over everything, by force. So there's those kind of risks involved. So what I'd like to see, investors consider, if they do, after they speak to their financial advisor.
Hello.
How are you?
Forgive me but I'm saying, for those who are interested in putting gold exposure in their portfolio, and they talk to their financial advisor about this, I feel that the three main areas that they may want to consider analyzing for potential inclusion in their portfolio: gold bullion, because again, that is the purest form of diversification away from paper assets. And the great thing about bullion coins, like for example, for us in America, you have the gold eagle, and there's also the silver eagle as well. Millions of those are bought and sold every week across the globe. Very liquid market. You can buy easily, you can sell easily. And I think that they are a great way to hold the physical. And by the way, gold eagles come in multiple denominations. Yeah, you have like a full ounce gold eagle. Then there's the half ounce, quarter ounce, and even a tenth of an ounce. So people can easily participate in the gold bullion. Not to be confused with numismatics. That's a different animal altogether, which I don't want to touch in this area. But the remaining part is you have the whatever the quality or large cap gold and silver mining equities are, the mining stocks. And I think those actually have, in the year 2026, very strong fundamentals. I think that they could do very well, because gold and silver are at high elevated levels. And they, when you count what they have in the ground, and when you look at them through the traditional means of income and expenses, and potential net profit, and they have a rising value of their inventory. So they are very powerfully positioned for great growth in the coming years. And ETFs, well, look, if you have a 401k and you want gold exposure and you don't have the ability, to do it, but thank goodness we have many quality gold ETFs out there to participate. So when the investor talks to their financial advisor, hopefully they'll understand the value of having this as in part of their diversified portfolio, and including a little bit of this across the board, so that again you have the benefit of gold and silver, in the situation that we have today, so that we can continue to forge ahead and get the prosperity rolling for our families and friends.
Juan Carlos, from your institutional work, what allocation or rebalancing decision matters more than correctly forecasting gold's next price?
Great question. And I think that this is where the strategic role that gold can play is important. And I think that Professor Harvey was alluding to that earlier, right? And Paul has also mentioned that in the context of how you think about allocations and building your portfolio, right? So our analysis suggests, as well as many of the conversations that we have with institutional investors, that for many, gold is considered or is viewed as a strategic asset. That means that it's a part of the menu all the time. That obviously doesn't preclude investors from overweighting or underweighting that allocation, but that role can be quite important because you cannot time the market. If we were able to time the market, then we would be in a completely different situation, right? But because of that property of diversification, risk mitigation, liquidity, and long-term store of value, that can bring kind of like a positive overall contribution, right? So what we've seen based on our analysis and also in terms of practice is that usually portfolios with allocations to gold between 2 and 10%, depending on, of course, the constitution of the portfolio, other assets they hold, the objectives of the investors, the particularities of the families, the people, institutions, are quite important, of course, and that dictates the right mix. At the institutional level, especially if we look at, for example, pension funds, endowments, foundations, these large asset holders, those allocations tend to be kind of like somewhere between 2 and 5%, in practice. And that's what we've seen. They have been kind of like increasing over time. There is just one thing that I want to mention that I think is quite important to understand on the gold market. And I would 100% agree that in the very short term, gold should not be seen as an inflation hedge because there are other mechanisms and ways to do it. But it is also important to understand that inflation, it really depends on what you're measuring. 60% of gold demand is actually linked to Asian markets, right? So if we think inflation, US CPI, that may not be necessarily the most relevant metric, right? In many ways, our analysis shows that thinking about money supply as a broader sense of understanding how fiat money is depreciating, so to speak, relative to an underlying more stable asset, could be a more comprehensive way, like global money supply, to understand this tension, right? And the way to think about gold in the broader context. And but I think that for many institutional investors, that tends to be true as well.
Well, thank you for those insights. Thank you to Juan Carlos, to Paul, and to Cam, who dropped off already. I thank you for sharing your expertise with us in making this such a thoughtful conversation. And to all of our inspired moneymakers tuning in today, I encourage you to continue following our guests and their work. You can follow Juan Carlos Artigas. He has been at the World Gold Council since 2009 and is head of research. You can learn more at gold.org. Follow Cam Harvey at Cam Harvey on LinkedIn and on X. And be sure to listen to Cam's Through the Noise podcast, where he shares his insights on pressing topics within the worlds of economics and finance. I will share a link to his research in the show notes, and connect with Paul at ravingcapitalist.com. Also check out his All the Investing for Dummies series, which is very impressive. So I will include the links in the show notes. Thanks again to our guest panelists. You may leave the studio. We're going to bring in UC Berkeley economist Barry Eichengreen. He's going to join me to explore 2,500 years of international money history. No global currency dominates forever. From ancient gold coins to the British pound to today's US dollar, monetary power ultimately depends on something more valuable than metal, and that's trust. If you're just joining us, welcome to Inspired Money. I'm advisor Andy. My next guest has spent his career studying how global currencies rise, endure, and eventually lose influence. Barry Eichengreen is Distinguished Professor of Economics and Political Science at UC Berkeley. He's also one of the world's leading authorities on international money history. I have a copy of his newest book here, Money Beyond Borders, Global Currencies, From Croesus to Crypto, and it traces 2,500 years of international money to help explain what may come next. Well, we're going to explore why central banks still accumulate gold, whether the dollar's dominance is beginning to erode, and how gold stablecoins and new payment networks could fit into a more multipolar monetary system. Barry, welcome.
Thank you, Andy. It's good to be with you. There's a lot of low quality discourse about the role of gold out there. So it's delightful to be on a platform following that very intelligent discussion you've been having for the last hour.
Well, thank you for joining us and helping with my effort to provide higher quality content. Let's get right into it and go into segment one.
Gold has often functioned as more than a physical commodity. It can also serve as a barometer of institutional confidence. Consider the Byzantine Solidus, the dollar of the Middle Ages. It maintained wide acceptance for centuries, supported not only by its purity, but also by fiscal discipline, commercial law, and institutional credibility. Contrast that with Rome's Denarius, whose long decline was accelerated by repeated debasement amid mounting fiscal and political strain. In the 1920s, the gold standard came under pressure as democratic governments became increasingly unwilling to subordinate employment and economic stability to a rigid metal peg. Today, the script has flipped. Central banks accumulate gold not to operate a monetary system, but as a form of reserve diversification and protection against economic, financial, and geopolitical risk. Does gold now function primarily as a speculative asset or as a form of institutional insurance?
Barry, your research takes us back to the Byzantine and Roman empires. What separates a currency that earns trust for centuries from one that gradually loses it?
I think a combination of a strong economy. You have to, the issuing economy has to be engaged in a substantial volume of cross-border transactions, which creates kind of a natural habitat for international use of its currency. Separation of powers, rule of law. There was a Roman Senate. There were powerful landholders during the rise of the Byzantine Empire who provided checks and balances on the emperor. You can kind of imagine where I'm going here in terms of questions about rule of law, separation of powers, control of corruption in the United States today. So not only a strong economy, but strong domestic political institutions. And internationally, the issuer has to be able to defend its borders against rivals, project power internationally, build durable political alliances. So again, you can imagine where I'm going here in terms of questions about the commitment of the United States to NATO, to its South Korean partners, and so forth.
Clearly, there are a lot of variables, and these things matter. In Golden Fetters, another book of yours, you showed how the gold standard helped transmit the Great Depression. Was the fundamental problem gold itself or the policies required to defend the peg?
The fundamental problem was the policies required to defend the peg and the fact that with the expansion of the franchise, more people could vote in many countries after World War I than had been the case before. The commitment of governments and central banks to maintaining the peg began to become strained. Central banks came under pressure to bring down unemployment, stabilize the price level, stabilize the financial system, and there arose a conflict between the fixed price of gold, the stability of the exchange rate on the one hand, and economic and financial stability on the other. That's why I think more and more countries over time have abandoned pegged exchange rates, why the price of gold fluctuates more widely now than it did in the historic past. We, until recently anyway, we have been moving in the direction of more and more democratic politics around the world, which in my view is incompatible with prioritizing the stability of the exchange rate and attempting to stabilize the domestic currency price of gold.
Your research identified a group of emerging market central banks actively diversifying into gold. What most surprised you about who was buying and why?
Well, it's an interesting phenomenon that in the period before the global financial crisis of 2008, 2009, advanced country central banks, which had inherited a lot of gold from the past, had been gradually trimming their holdings in an orderly, coordinated way designed to prevent destabilization of the global gold market. Since then, emerging market central banks have been adding gold to their portfolios. So many of them did not inherit large amounts of gold from the past. Many of them had had to expend their existing gold reserves in the face of financial crises. But emerging markets have been growing faster, have been displaying better financial stability, and they're the ones that have been accumulating gold reserves since 2009-10. I think they were reminded by the global financial crisis that holding securities, US Treasury bills and bonds and other foreign securities is not without risk. So as you heard in your first hour, they have been diversifying on the margin toward gold as a form of portfolio diversification, really, and risk reduction.
When people describe gold as institutional insurance, what risk is it actually insuring against? And where does that analogy break down?
Well, I think it is insuring against expropriation risk, against sanctions risk. So we saw the Bank of Russia, Russia's central bank, double the share of gold in its international reserves between Russia's annexation of Crimea in 2014 and Mr. Putin's attack on Ukraine in 2022. The Bank of Russia immediately saw its dollar reserves, most of its foreign exchange reserves, except for those held in China, immediately frozen as a result of that attack and the sanctions that it elicited. But the gold that Russia had accumulated and repatriated, that it then vaulted exclusively in St. Petersburg and Moscow, was free from that expropriation risk. So I think that's the primary concern. Central banks are also concerned to insulate their portfolios from loss of value due to foreign inflation, due to declines in foreign bond prices. So central bank independence, as we've seen recently, is fragile, and central banks maintain it by hitting their inflation targets, but also preserving the value of their balance sheets, their investment portfolios, and diversifying their portfolios is one way of going about that.
Let's continue to segment 2.
International currency status is not guaranteed to be permanent. It rests on a combination of economic strength, market liquidity, and geopolitical trust. Allies are often more willing to hold the currencies of partners they trust. Today, some of the most important risks to the dollar may come not from a single foreign rival, but from domestic fiscal and institutional pressures, including rising debt, political pressure on the Federal Reserve, and concerns about institutional credibility. While the dollar can still strengthen during sudden shocks, gradual erosion could accelerate if confidence weakens or alliances fray. In 1971, Treasury Secretary John Connally famously told America's partners, "How should investors interpret that divergence or problem?" Today, has it become our currency and our problem? Some institutional forecasts emphasize continued monetary and financial stability, while others place greater weight on structural diversification.
Barry, what are the clearest signs that a dominant currency has begun a genuine decline, not merely a temporary setback?
Well, I think one has to look to what economists call convenience yield. In other words, the fact that the dollar is a convenient asset for central banks, corporate treasurers, governments around the world to hold. That has enabled the US Treasury to borrow at a lower cost than would be available to it otherwise. It has enabled the Treasury to do that historically, but a variety of economists have documented how that convenience yield has basically evaporated in recent years. So I look to that as one important current and forward-looking indicator. Another one is that the share of US Treasury securities that are held abroad has been in decline for the better part of a decade now. And a majority of those securities, once upon a time, 10 years ago, were held abroad. Now a majority is held at home in the United States as the appetite of foreign investors, both official and private, has begun to diminish. I think those are the most immediate indicators, at least in the current case of the dollar.
In your research, is there any historical currency that we can look at in the past that you can use as an analogy for the US dollar today?
Well, I think there are many analogies, and in my book, I go through like a dozen of them, going all the way back to the Byzantine Empire and the Roman Empire and even ancient Athens, as you summarized at the top of our segment. Every analogy is imperfect. Every case is different, but I think by and large, they point to the three factors that I emphasized before: health of the economy, strength and confidence in domestic political institutions, checks and balances and rule of law, and military strength and the durability of a country's international alliances. So the mix of those three factors that has tended to weaken over time and erode the centrality of a dominant international currency is a little bit different in every case. My view of the role of history and historical precedent and historical analogies is to point out the differences between cases as well as the similarities. So there's no perfect analogy, but there is a big handful of them, and I go through them in my book.
Indeed, you do. And you also emphasize that the dollar's greatest vulnerabilities may be domestic. Which do you think matters most today? The fiscal trajectory, the Federal Reserve independence, the rule of law, or confidence in American alliances?
Well, I think certainly questions about debt sustainability in the United States, questions about the independence of the Federal Reserve, questions about whether what looks to be strong economic growth is based in substantial part on a bubble or not. All of those things matter importantly, but none of them are news. They have been on investors' radar screens for quite a while. What is new and different since 2025, which renders me more pessimistic about the dollar's future prospects, are questions about rule of law, separation of powers, control of corruption in the United States, and questions about our commitment to our alliance partners. I would emphasize again that countries like South Korea and Japan have held a larger share of their reserves in dollars, done more cross-border business in dollars than normal countries would and do, because doing so is a show of good faith in their alliance partner, the United States of America. And now there are new questions about domestic political institutions and international alliances that I think will figure importantly in the calculations of central banks, governments, and private investors going forward.
John Connolly called the dollar our currency, but your problem. In what sense has global dependence on the dollar now become an American problem too?
Well, it is an American problem insofar as we in the United States derive considerable advantages from the dollar's centrality in the international system. US banks and firms have the convenience of being able to do cross-border business in their own native currency. The Treasury has historically been able to borrow at lower cost, something that an advantage that accrues to US taxpayers. We've derived automatic insurance from the dollar's safe haven status, that funds flow into US financial markets in the dollar rather than out when global volatility spikes. And our financial sanctions are more effective than they would be otherwise as a result of the centrality of the dollar and the US correspondent banking system for cross-border transactions. All of those advantages could be significantly eroded or even lost if we jeopardize the importance of the global dollar.
Let's bring it home and go to segment 3.
The dollar still accounts for roughly 57% of global foreign exchange reserves, while the renminbi represents about 2%. The euro faces structural constraints, yet change does not require a single successor to the dollar. Historical experience suggests that private money can be vulnerable to instability, and modern stablecoins may echo some features of 19th century free banking. One possible evolution is greater currency diversity, supported by modern digital payment rails. As America's share of global output normalizes, maintaining a completely unipolar monetary order may become increasingly difficult. In a more multipolar world, gold may gain importance as a non-sovereign reserve asset without an issuing country's liability. Would gold in that system primarily hedge dollar weakness, or provide broader protection against geopolitical and counterparty risk?
Barry, if no single currency is ready to replace the dollar, what would a multipolar monetary system look like in everyday trade, payments, and central bank reserves?
It would be a system in which those engaged in cross-border payments, firms, banks, central banks, and others have a variety of options. We have seen such a system before under the gold standard before 1913, actually settling transactions, making payments using gold bars or gold coins was awkward and costly. So the financial payments were settled using British pounds, French francs, and German marks. That was an example of a multipolar monetary and financial system organized around 3 financial centers in London, Paris, and Hamburg/Berlin. So we've seen it before, we know how it works, and I think it could develop again in the future. The difference now, as your last introduction indicated, is that with the rise of digital platforms, trading platforms, electronic payments, it's possible for the currencies of smaller economies also to play an international role. So I'm thinking about the currencies of Australia, New Zealand, Canada, South Korea, Singapore, the Nordics. All of them already figure more importantly in central bank reserve portfolios now than they have in the past. All of them are easier to use in direct local currency settlements. Central banks around the world are trying to build platforms to link their fast payment systems, eventually in the future to link their central bank digital currencies. So I think we're moving in a more multipolar direction, but not one necessarily organized around the currencies of the three large economies, the US, the Euro area, and China.
It sounds like technology will have a major impact. Across the innovations you trace in Money Beyond Borders, which one most transformed who could issue or inspire trust in international money?
Well, I think the rise of independent central banks was an important element. That's why I worry about threats to central bank independence today. I do emphasize in the book that monetary and financial technology is always changing. The rise of the bill of exchange, a purely financial claim that could be traded across borders, was an example of a critically important innovation in the past. Today, I do agree that the digital revolution is transformative, that distributed ledger technology, blockchain, as it's known, will be important going forward. But I don't think that stablecoins, privately issued tokens, supposedly pegged to a fiat currency like the dollar, I don't believe they'll be the main thing that will run on those new digital rails. I think tokenized bank deposits, commercial bank deposits, and central bank digital currencies will ultimately dominate. So we in the United States are taking a bet on stablecoins. They in Europe and China are taking a bet on tokenized bank deposits and central bank digital currencies. I worry that we in the US are betting on the wrong horse, and that will have negative implications in the long run for the global role of the dollar.
Interesting. Stablecoins promise faster payments and broader access to dollars. Can you elaborate or maybe give us some context? Like, what does the history of private money tell us about where the promise is strong, but maybe more importantly, where it can break down?
So I think the public good of stable money is natural monopoly, to put it in technical economic terms, and that an independent central bank is the natural provider and regulator of that stable money. I argue in my book that the arrow of history points strongly away from private competitive currencies toward publicly provided stable money. And I worry that those who advocate the adoption and use of stablecoins are ignoring or misinterpreting that history. So to repeat what I said before, I think you can be a believer that the digital revolution and blockchain are going to transform international payments and provide a new important sets of payment rails. You can believe that on the one hand, but be a skeptic like I am about stablecoins on the other hand.
Do you think that new cross-border payment rails ultimately are a greater challenge to the dollar dominance than the euro, renminbi, or cryptocurrency itself?
Yeah, I actually do. I think that the euro and the RMB face significant obstacles in terms of their aspirations to rival the dollar as international currencies. There is a shortage of high quality liquid assets in Europe. There are capital controls and political obstacles to the renminbi playing a larger global role. So I think that the challenge is likely to come from other quarters, from emerging markets and those non-traditional reserve currencies, the currencies of small, open, well-managed economies that I referred to before, and new digital technologies, including blockchain, will provide a medium platform on which they can be used and traded.
Since our topic has been gold today, in a more diverse monetary system, what role is gold uniquely equipped to play?
Well, I think gold is a geopolitical hedge, as you and I discussed at the top of the hour. It is a useful source of portfolio diversification, as your previous panelists described. It's a hedge against other kinds of risks. So I don't see gold playing an important monetary role. As I said before, gold is clunky for use in actual payments, and investors have always found superior substitutes for it when they're thinking about purely monetary and financial transactions. But as a form of portfolio diversification on the margin and a way of hedging geopolitical risks, I think it will always play a role.
Any views on the prospects of tokenized gold?
Tokenized gold hasn't taken off, as you know. Transforming the token into an actual claim on gold is not straightforward, given the way markets are currently organized. But I think there will always be a specialized customer niche for gold, and just like gold ETFs have become a thing in recent years, tokenized claims on gold are likely to play a role, at least on the margin, going forward.
Thank you. Barry, before we close, if you could please indulge me and finish this sentence. The future of money will be shaped less by blank and more by blank.
I think it will be shaped less by competition from aspiring rivals to the dollar, and more by number one, events in the United States, and number two, innovations in technology.
And for somebody who wants to better understand the monetary changes happening around us, what's one thing you would encourage them to read, watch, or do this week?
I cannot resist. You plugged my book at the top of the segment. I do talk in Money Beyond Borders about the past, present, and future of gold. I talk about the digital revolution. I write about stablecoins, and then I close with some forecasts about the future. You've got to look at the final chapter to learn what those are.
Well, thank you, Barry. Thanks for sharing your perspectives with us and taking us through, the times of Croesus and Byzantine, all the way to today's stable coins and the future of the dollar. Barry's new book is Money Beyond Borders: Global Currencies from Croesus to Crypto. And this is a big endeavor. You have a lot of history, a lot of information about currencies and cross-border transactions, and gives us plenty to think about. So thank you, Barry.
Thank you.
Inspired Moneymaker, I encourage you to continue following Barry and his work. You can learn more at econ.berkeley.edu. And we'll include links to Money Beyond Borders in today's show notes at inspiredmoney.fm/blog. I also want to thank Juan Carlos Artigas, Cam Harvey, and Paul Mladjenovic for joining today's panel. My takeaway today is simple. Gold's next price move is uncertain, but the reason you own or don't own, it should never be. That is definitely more certain. If this episode helped you think differently about gold and the future of money, subscribe to Inspired Money and share it with somebody who would value the conversation. And let us know in the comments, what role, if any, does gold play in your portfolio? Let's stay connected. You can find me on LinkedIn. Just search for Advisor Andy. And if you're listening to the podcast, send me a message and let me know what resonated with you or what topics you'd like to explore in a future episode. A special thank you to the Inspired Money team, Bradley John Eaglefeather and Chad Lawrence, for helping to bring these fascinating conversations to life. Thank you for joining us. Until next time, do something that scares you, because that's where the magic happens. Thank you, everyone.